Good day, everyone, and welcome to Overberg Asset Management Global Markets Quarter 2 Review and Outlook for the second half of this year. It certainly has been another interesting quarter. We've seen record highs in the S&P 500, the Nasdaq, and the Nikkei. We've seen a record IPO in the listing of SpaceX, and all this while the conflict in the Middle East rages on. Helping us to make sense of all of this, we've got Nick Downing, CEO and Chief Investment Officer at Overberg Asset Management, a company he founded in 2001. On the agenda today, we've got global economic and market review. We've got the economic and market expectations. Then we'll look at the projected asset class returns. We'll have a review of Overberg Asset Management Global Portfolios, and we ended with a summary. I now hand you over to Nick Downing.
Thank you very much, Carl, for your kind introduction. It's wonderful to have the opportunity of presenting again to all our clients and all interested parties. And wow, what an incredible second quarter it's been. I'm going to start off the global economic and market review. The US and Iran announced a tentative peace deal on the 14th of June, including the end to hostilities and the removal of Strait of Hormuz blockades. This sent oil prices sharply lower. Brent crude, which had spiked to $118 per barrel at the end of Q1, fell back to $73 by the end of Q2, raising the war premium and even ending below its pre-war level of $74. With the energy shock fading as quickly as it arrived, the underlying strength of the global expansion, broadening growth, robust earnings, and an accelerating AI investment boom reasserted itself, carrying several major indices to record highs. The run-up in global stocks was driven by the technology sector, which gained close to 25% in Q2, while the rest of the market gained about 6%. The strength of technology stocks was fueled by semiconductors, which increased by nearly 60% in Q2 on the back of a massive rise in memory chip prices. The S&P 500 index surged 15% in Q2, its best quarter since 2020. Japan's Nikkei 225 gained 37% on the quarter. And wait for this, Taiwan and South Korea, their chip-heavy stock indices surged in Q2 by an extraordinary 45% and 68% respectively. Accommodative monetary and fiscal policy settings contributed to strengthening global trade and broadening and deepening global economic activity. 2026 earnings projections kept moving higher, a phenomenon seen across all regions and not solely restricted to technology and energy sectors. The vast majority of sectors in the MSCI World Index enjoyed net earnings upgrades. SpaceX made its historic public debut on the Nasdaq exchange on the 12th of June, raising $86 billion and valuing the company at $1.8 trillion. This dwarfed the previous largest IPO, when Saudi Aramco raised $29 billion in 2019. The SpaceX IPO is the first of a coming pipeline of monster IPOs, valued in aggregate at more than $4 trillion, equivalent to around 6% of current S&P market cap. These IPOs include Anthropic and OpenAI, each valued at close to $1 trillion. Besides the Bank of Japan, an outlier which, after ending a 17-year period of negative interest rates, has been steadily lifting its benchmark interest rates since March 2024, all major central banks have, until the start of the year, been on an easing bias. But the energy shock and increased inflation has prompted a change to a tightening bias. The Bank of Japan hiked its rate to 1% on the 15th of June, and the European Central Bank was the first of the other major central banks to join the hiking club, with a 25 basis point rate hike on the 11th of June. The Federal Reserve, now chaired by Kevin Walsh, after Jerome Powell's term expired in May, struck a hawkish tone at its inaugural meeting in June. Markets that began the year expecting further easing from the Fed now price in some 30 to 50 basis points of increases by year end. The sturdy global economic expansion and persistent above target inflation, combined with high public sector deficits and debt levels, and strong investment demand for capital, has kept upward pressure on sovereign bond yields. The all-important US 10-year Treasury yield rose from 4.31% at the end of March to 4.42% at the end of June. Let's turn our attention now to what we're expecting in the economy globally and markets globally. The ongoing economic expansion and accommodative monetary and fiscal policies point to equity market outperformance. Forward earnings expectations are rising across most major markets and most sectors, underscoring that the uptrend is broad-based. Equity prices are supported by very strong earnings expectations. Global 12-month forward earnings have surged and in aggregate are up nearly 30% compared with a year ago. They have been boosted by the tech sector, where forward earnings are approximately double year-ago levels. You can see the wow on that graph. S&P 500 bottom-up forecasts are rising sharply for the remainder of 2026 and for 2027. Although AI continues to be the dominant theme, strength in earnings growth is evident across nearly all sectors, with upward revisions uniformly positive. The June peace accord officially broke in early July, following renewed escalations, including Iranian attacks on commercial vessels in the Strait of Hormuz, followed by retaliatory US strikes and the reimposition of oil sanctions. The ceasefire collapse does not come as a surprise, given the ambiguity over Iran administering traffic through the strait. Moreover, Iran has far more leverage ahead of the US midterm elections on the 3rd of November. Shipping will only gradually and partially resume and will continue to be impeded by periodic setbacks in diplomacy. However, as both Iran and the US have a strong incentive to avoid a prolonged war, the oil price is likely to settle in the range of $70 to $90 per barrel, well below peak levels reached in Q2. There is great divergence in opinion on the monetary policy outlook. Interest rate futures are discounting 1 or 2 basis point rate hikes from the major central banks by year end, but forecasts are spread dramatically on either side of the consensus. In the US, inflation has run ahead of the Fed's 2% target for more than 5 years, prompting some economists to predict 75 basis points in Fed hikes over the next year. Other economists are less pessimistic. It is quite likely that Fed Chair Kevin Walsh, having burnished his credibility with a surprisingly hawkish tilt in his first 2 months in office, may opt for just one hike, one and done. Inflation, after all, is softening faster than predicted. The June US headline CPI actually contracted month on month by 0.4%, the biggest monthly decline since April 2020. Core inflation, excluding energy and food prices, was 0.0% on the month and slowed year on year from 2.9% in May to 2.6%. At the ECB, meanwhile, policymakers may resist follow-up rate hikes, with inflation only slightly above the 2% target and falling. Our belief is that most central banks are set to remain on hold, creating a low interest rate volatility environment. Hence, the era of excessive liquidity should persist. Financial conditions remain easy in the world's largest financial market. Even if the major central banks follow through with 1 or 2 rate hikes, global liquidity will continue to be plentiful. The equity market can tolerate higher bond yields when they reflect stronger growth, but not when they reflect tighter policy, inflation pressure, or fiscal stress. Bond market volatility and a rise in the all-important 10-year US Treasury bond yield to new cycle highs would impact global liquidity and the valuation multiples attributed to equity markets. There would be considerable downward pressure on equity markets if the 10-year Treasury yield reaches the key 5% threshold and gains further to 5.5%. We will be keeping a close eye on the inflation trajectory and public sector debt and deficits. The coming IPO pipeline is big, currently valued at more than $4 trillion, equivalent to 6% of current S&P 500 market cap. IPOs tend to underperform after listing, and IPO waves are usually followed by more muted market returns and multiple pressure. But there is no empirical evidence that they are a clear-cut bear market signal. Indeed, low net issuance and ongoing buybacks suggest the market can absorb the supply of new listings. although investors may fund new AI IPOs by trimming existing AI winners. Many parallels have been drawn between the current boom in AI stocks and the dot-com bubble. Most are agreed that tech stocks are at risk of a sharp decline in the order of 30 to 50%. But this is more likely a story for later in 2027. CapEx projections suggest that investment in AI infrastructure will continue to rise at its recent pace for at least the next couple of years. Adoption lags of big technologies have been falling in recent years, and indications are that AI is progressing at the quickest pace yet. Admittedly, the pace of earnings growth may not be sustainable, but this has largely been factored in valuations. In fact, the forward PE multiple of the combined S&P 500 tech sectors is at its cheapest since 2023, excluding the Iran conflict and the tariff wars Liberation Day. There is a persuasive argument that AI stocks are not in bubble territory, and that the current backdrop more closely resembles the mid rather than the late 1990s. Valuations are far from 2000 levels, when technology comprised 32% of market cap, but only 12% of earnings. Today, it comprises 43% of the market cap and 38% of earnings. AI adoption is now entering a faster, more economically meaningful phase, moving beyond experimentation and novelty into mainstream consumer and enterprise use. The compute backlog keeps growing, shown in the chart at just under $1.5 trillion. And so far, Taiwan and Korea have been conservative in increasing production capacity. Upward revisions to earnings growth estimates are based on solid fundamentals. The market has assumed that the US hyperscalers' CapEx binge is wasteful and accordingly has punished their share prices. The 12-month forward PE ratio of the hyperscalers has reduced to 20 times, a 10-year low. This is half the peak valuation in 2020 and suggests considerable upside potential. Let's look at OAM's global portfolios, how they're positioned, and what our thinking is. During the quarter, we sold the remaining holding in Finsbury Growth and Income. Several of Finsbury's largest holdings, London Stock Exchange Group, Redex, Experian, Sage, Auto Trader, and Rightmove, have business models that rely on data and software enablement, which face significant threat from agentic AI solutions. Compounding the poor outlook for Finsbury, the UK is rapidly emerging as the least healthy of the G7 economies. Proceeds from the sale were added, in the case of global growth portfolios, to the existing holding in Schroeder Asia Pacific, and in the case of global balanced portfolios, 3/5 was added to Schroeder Oriental Income and the remaining 2/5 added to the existing cash weighting. Following a 70% share price increase over the prior 12 months, we took profits in Edinburgh worldwide following the successful IPO of its largest holding, SpaceX, which now comprises around 20% of net asset value. Being such a large component of Edinburgh's portfolio, there is considerable concentration risk. The Edinburgh holding was reduced in the global growth, global balance, and global defensive portfolios by 28%, 36%, and 50%, respectively. Proceeds were switched into investments with a lower risk profile. In growth portfolios, all proceeds were used to increase the weighting in Rothschild Capital Partners with its sizable exposure to uncorrelated strategies. In the balanced portfolios, proceeds were allocated to 2 existing holdings, again Rothschild Capital Partners, but also Personal Asset Trust, which is even more defensive given its sizable allocation to inflation-adjusted government bonds. In the defensive portfolios, proceeds were used to increase exposure to short-dated US Treasury bonds between 1 and 3-year maturity. We are in the late stages of one of the longest investment cycles in modern history. Bull markets do not die of old age, and there is no clear catalyst to end the current cycle. Earnings are growing strongly, and there is no sign of recession on the horizon. Yet, valuations discount extravagant earnings forecasts and record high profit margins, which cannot be sustained indefinitely. We are closely monitoring 4 potential triggers, which we identify as the biggest threat to the investment cycle. Namely, 1, a destabilizing bond market shock from sharply higher government bond yields. 2, a policy shock that damages corporate confidence or profitability. 3, preemptive investor de-risking in the face of tightening liquidity. And 4, a deflating of the AI-driven technology bubble. Caution is therefore required. The fundamentals support a continuation of the bull market over a 6 to 12-month horizon, assuming the Strait of Hormuz crisis does not escalate much further and bond yields rise gradually rather than disruptively. But the window of clear upside is narrowing. The risk asymmetry, modest additional gains against the prospect of sharp, potentially rapid reversal, suggest the need for caution. This chart from independent research firm Capital Economics shows return forecasts for major equity markets for the remainder of 2026, the light blue lines, 2027, the grey bars, and 2028, the dark blue bars. Decent further gains are expected in most markets in the second half of this year. However, earnings disappointments will eventually lead to a correction, and negative returns are predicted across markets in 2027, with losses most pronounced in markets with a high AI concentration. The correction is expected to be sharp but short-lived, with markets rebounding and logging gains in 2028. As demonstrated by our portfolio trades over the past 2 quarters, and even before that at the end of 2025, we have been using market strength to gradually de-risk portfolios by reducing positions in extended assets, increasing positions in uncorrelated or safer asset classes, and raising cash weightings. In the current environment, capital preservation matters just as much as generating returns. Besides higher cash weightings, Overberg's portfolios are well diversified across the world's economies and across asset classes, designed to mitigate risk while maintaining exposure to market upside. The portfolios have been stress tested over numerous investment cycles and continuously improved over the past 25 years to provide optimal and cost-effective diversification. OAM has a long track record in managing global private share portfolios. Going back to 2002, £100 invested 23 years ago would now be worth over £500. Has not been a straight line, but it is staying in the market that compounds investment returns. The annualized return in pound sterling net of all fees is 7.6% over the past 23 years, and in rand terms, 9.7%. After a strong 2025, when the OAM growth portfolio beat its benchmark by a decent margin, performance in 2026 has slipped slightly below benchmark, although since the market rebound in April, the portfolio has been catching up. Asset allocation and global allocation is diversified across asset classes, regions, and currencies in a private multi-asset class global portfolio. The balanced portfolio shows a similar trajectory, although due to its lower equity exposure, exhibits less volatility. The annualized return is surprisingly slightly above that of the growth portfolio. This is due to unusually strong returns in the bond market in the decade following the global financial crisis in 2008-2009. The annualized return in pound sterling net of all fees is 7.7% over the past 23 years, and in rand terms, 9.8%. Thank you very much for your patience. Just one more slide to go, in fact, a few, our summary. So to recap, the ongoing economic expansion and accommodative monetary and fiscal policies point to equity market outperformance. Forward earnings expectations are rising across most major markets and most sectors, underscoring that the uptrend is broad-based. We are in the late stages of one of the longest investment cycles in modern history. Bull markets do not die of old age, yet profit margins are at record levels and cannot be sustained indefinitely. Caution is required. We have identified 4 potential triggers that would likely end the investment cycle. Sharply higher government bond yields, a policy shock, tightening liquidity, or deflation of an AI-driven technology bubble. None are yet in evidence, but we are monitoring them closely. We have been using market strength to gradually de-risk portfolios. There is an emphasis on diversification by reducing positions in extended assets, increasing positions in uncorrelated or safer asset classes, and raising cash weightings. In the current environment, capital preservation matters as much as generating returns. Thank you very much for listening, and we wish you good health and happy investing. Thank you.